Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host here at the CME Group in New York. My guest today is George Milling-Stanley, former director of the World Gold Council, now independent consultant. George, great to have you back again.
Thanks for inviting me, Mike. Good to be here.
So, very interesting. I want to talk, recently we have seen the Dow Jones move to an all-time record high, over 17,000. And you would think under those circumstances, especially given the fact that not a lot of individual investors have really gone into the stock market, they haven't participated, you would think now you'd see some of that money flowing into stocks and maybe pressuring gold down, because they have been big investors in gold over the past several years, but that really hasn't happened. Gold has been holding steady. So how do you explain it?
Yeah, I think that we're seeing a lot of institutional money coming into stocks, not so much the individual investor, and it's the individual investor that has been driving gold and keeping gold high. Basically, I worry about stocks, I worry about any asset when it detaches from the underlying realities of the market. I think that's what's happening with equities right now, and there's a lot of people like me who believe in gold as an asset class, who believe that gold represents better value. If you think about it, gold is an asset that has come down about 30% from an all-time high a couple of years ago, and is building a base somewhere about 5 times where the price was just a decade ago. And you compare the attractiveness of that with an asset class that's just gone up 35% to an all-time high, and my portfolio rotation models tell me that I should be lightening up on equities and heavying up on the commodity side.
But you're a sophisticated guy. You're a sophisticated investor. Typically what we see is the small investor chasing after rallies in stocks, and that begs the question, why would, it's interesting to me, why would the behavior change? I mean, historically, we've seen small investors gravitate to stocks. There always has been an interest in gold. I would say somewhat of a fringe interest. It has become bigger, but now are we really looking at some sort of a behavioral change? Like people just shun stocks and they want to own gold?
I think people have been moving into stocks in quite a big way over the past few years, and that's why stocks are at an all-time high, and they seem to be hitting fresh all-time highs. And speculative demand can drive markets to crazy levels. We saw that with gold in 2011, where it was the speculative money took gold from $1,400 an ounce to $1,900 an ounce, and then over the next 18 months all the way back down to $1,300 where we are today. And we're seeing that kind of thing, I think, in the stocks. We haven't yet seen the blow off at the top in the stock market. That will be when the retail money really comes in, the individual investor really piles in saying this is going to go up forever, and that's precisely when it stops going up.
Now, price-wise, gold in the 1,200 level, it's been here in a tight range for a fairly long period of time. What, in your opinion, would be the catalyst that would move it out one direction or another, preferably higher, let's say?
At the moment, Mike, I'm really happy that gold is building this base. I'm calling it between about 1,200 on the bottom end and about 1,350 on the top end. It's a wide range because I hate to be wrong, so I'm picking a wide range. It'll take a while for gold to move out of that. And I think the longer we build that base, the better the next bounce will be when that eventually comes. The catalyst, I think we've got gradually improving fundamentals, just as we've had all the way through since this bull market began back at $250 an ounce in 2001, gradually improving fundamentals of supply and demand. I don't know that that's necessarily going to be the kicker that provides the bounce up above 1350. That will probably be a big increase in investor and speculative demand, and it's going to take something bad happening, for example, with the equities, or with geopolitical tensions, or with inflation numbers starting to sneak up. It's going to take something like that to give us the blow off in stocks, and that will be the incentive for people to go back into gold.
Let's talk about monetary policy for a second, because basically, we can go back to the Lehman crisis 6 years ago when central banks, led by the Fed and eventually central banks all over the world, pedal to the metal, quantitative easing, monetary policy, dropping interest rates. It was all supposed to be inflationary. Some were saying hyperinflationary, okay? Now it seems like we may be approaching the end of that policy era. The Fed recently said that its asset purchases are going to end in October. There's already speculation about when rates are going to rise. I kind of find it interesting that gold is holding up so well in light of this expectation of a reversal in monetary policy. What do you think the effect would be when we finally do see that first hike in interest rates?
I think that the effect could be marginally bad for gold at that point.
Would that be a buying opportunity?
I think it's a buying opportunity because you think about the last time we had significant and regular increases in interest rates under Alan Greenspan back in the 1990s, and everybody expected gold to go down and the dollar to go up. What happened was people said, well, if the dollar needs this kind of protection with interest rate rises this regularly, then it must be even worse than we thought. So they bought gold and sold the dollar. It wouldn't surprise me to see them do the same again. But I don't think we're going to be in any hurry to raise interest rates. Yes, they're going to stop the quantitative easing. That's only half the program. Zero interest rates are with us for quite a while yet. Charlie Evans at the Chicago Fed said probably until 2016, just recently. We're going to see that for a long time.
But I totally agree with you on the rate hike being a positive for gold as opposed to a negative. If you think about it, it's a de facto fiscal stimulus. The government's paying more interest, and that's really the money printing that everyone thought would happen under quantitative easing, which wasn't really. I want to just segue a little bit to the international perspective. Gold import tax in India right now, and I want to talk a little bit about China. I mean, we can't leave those two out. They're very important for the overall outlook.
Yeah. Now, India and China collectively are something like 50% of each year's gold jewelry demand, and that in and of itself is around about 2/3 of total demand. So they're very important. We're hearing all sorts of noise from India about rolling back all of the increases in import taxes and tariffs that they put on a year or two ago, but we're not seeing any activity at this point. But the Indian consumer is buying ahead of this, expecting this to happen, and that means the Indian retailers are stocking up ahead of it as well. So we're seeing an increase in demand, even though there's been no change yet on the import duties. As far as China's concerned, the economy may be slowing very, very slightly, but that has so far has not had any impact on gold imports. They're still importing an enormous amount of gold because they're increasingly wealthy, because they like gold, and because they're suspicious of the US dollar. They're expecting the US dollar to resume its long-term secular decline that it started in 2002 and that has been temporarily interrupted by safe haven demand during the crisis. Once Europe gets its act together again, and once the Chinese continue to internationalize the renminbi, you'll see serious competition emerging for the dollar, and I think that's going to be helpful for gold in the next year or two.
Okay, so basically bottom line now, gold establishing a base. If you're in it, stay patient. Medium term, long term, still looks pretty good.
To me, absolutely. I mean, I think if people are not invested in gold at this point, then it's a buying opportunity. I'm just waiting to put the rest of my allocations into gold until we break out above this range. A sustained move above 1350, and by sustained, I'm talking about a month or 6 weeks. A sustained move above 1350 will be my next big buy signal.
Great. George, always a pleasure. Thanks very much.
Mike, good to see you again.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.